Here are three most important rules you need to when trading the Asian range. A lot of people find it hard identifying the correct Asian range. Well, in this video, I'm going to be clarifying some things, and hopefully by the end of this video, you'll be able to apply these rules and only trade the correct Asian range. Well, if that sounds interesting, let's get into it. The first and foremost rule when trading the Asian range, when identifying the correct Asian range, is the Asian range has to be 25 to 50 pips max. It can be less than 25 pips, but max it has to be 50 pips. Now, what do I mean by that? Let's say this is the Asian range, right? Represented by this blue box. Now, when I say that the Asian range has to be 25 to 50 pips, what I mean is when you measure the box, the Asian range, the whole Asian session box, it has to be 25 to 50 pips. So from the top of the Asian box to the bottom of the Asian box has to be 25 to 50 pips. It can be a little bit above 50 pips, like 55, 53, 56, but it must be in that range of 25 to 50 pips. Just it can be a little bit above, just like that. So this range has to be 25 to 50 pips. Now, why 25 to 50 pips? The reason why it has to be 25 to 50 pips is because it's based off of the Asian session consolidation. It's based off of the consolidation that happens during the Asian session. Now, the consolidation is the reason why there's liquidity at the top and there's liquidity at the bottom of the range. Right? That's why it's called the Asian range, because it's the ranging market, is sideways. And we know that consolidation doesn't really offer a lot of pips. Consolidation cannot be 100 pips, depending on the pair. If it's gold, you can have consolidation for 100 pips. But on the normal Forex pairs, GBP USD, Euro USD, GBP pound, GBP NZD, all those pairs, the normal Asian range, the normal pip movement is for a range is 25 to 50 pips. Right. So that confirms your consolidation. Now, what you do not want is something like this. So if you have something like this and is measure if you measure it and the measurement is about, let's say, 80 to 100 pips. Now let's say this range, this is the Asian box. Let's say this box is 80 to 100 pips. Now you cannot trade this. There are certain ways to trade this, but that has to deal with some background information like the high of the previous day, where you are in the market and things like that. But on average, the basic is that the range has to be 25 to 50 pips. This is more advanced and it doesn't really have a high accuracy like the way this one has. So what I'm saying now is the 25 to 50 pips box, the range is usually tight. The lower the pips, the better. So if it's like 25 pips, that's even better. That's ideal. Now on a box that is blown out like this, that is past the 50 pip mark, it's gonna look something like this. So you're gonna see all these movements. So this is basically not consolidation. This is market moving in an upward direction, right? So what will basically happen when you get something like this is the market will just begin to consolidate all throughout the day and maybe continue up for the day, right? So that is rule number one. Rule number two is you need to see aggressive movements outside the Asian box. Now, we know that the Asian box creates liquidity, and we know that two things happen after the Asian range consolidation. So let's say this is our consolidation here. There are two things that happens. When the market breaks to the upside, what happens? We know that there's liquidity at the top and there's liquidity at the bottom of the range. Now, we know that when the market breaks to the upside, it's taking out this liquidity that's at this top side. And we know that it's not only taking out the liquidity at the top side, but it's also inducing people to get in on this trade on buys. Now, breakout traders are going to be taking buys, right? So breakout traders are taking buys. What makes a breakout trader excited? What makes them believe that the market is going to continue up? We know what they call momentum candles. So when you see candles that are big like this, just all of a sudden outside this consolidation, because this Asian range is about, it lasts for about 8 hours on average, right? So after 8 hours of the market not going anywhere, all of a sudden you have a breakout with one fat aggressive candle, and breakout traders see this as a confirmation to take their buys, especially if the trend has been going up for a couple of days. Now, this fast candle induces people to take buys. It's not only taking out the liquidity here, but it's also inducing people to take buys so they can reverse the market later on like this, right? So now, when you are trading the Asian range liquidity, or whatever you want to call it, the Asian range strategy or whatever, right? You need to see aggressive moves outside this box. You need to see, ideally, the move outside the box should be about 25 pips, 25 to 50 pips, right? Because we know retailers, the stop losses they use is usually 25 to 50 pips. So if the stop loss is usually 25 to 50 pips, that means liquidity is usually 25 to 50 pips above this Asian box and also 25 to 50 pips below the Asian box, right? So when the market breaks to the upside like this, it's taking out all the liquidity in this area. Now, what you do not want to do is you do not want to trade something like this. Let me just draw it out. You don't want to trade something like this. That's just let me see. You don't want to trade something that's just messing around in here like this. This is nothing, right? This is not inducing anybody to take any trades. This is just sideways consolidation. Maybe there was consolidation that continued here, so they're just continuing the consolidation or something like that, right? But this is not a setup, right? What you need to see is aggressive candles outside the box. You need to see something like this going out of the box. That is, more aggressive the move is, the better, right? So this aggressive move induces people to take buys, and then they form the famous M and W formation, double top or head and shoulders, and then reverse the market, right? So that is rule number 2. Rule number 3 is you need to know where you are in the market. Mainly know where you are, meaning know where you are in the trend. How many days has the market been going up? How many days has the market been going down? When did the trend just start, or is the trend about to end? Now, what I mean by that is we know that the market doesn't just go in one direction forever. So if you have an uptrend like this, we know that the market doesn't just go up forever. The market has to reverse. Market moves in cycles, right? Up, down, then back up, right? And then back down. We know that the market moves like that. It doesn't just go up forever like this, right? The market has been going up for, let's say, 3, 4, 5 days, just straight up like this in one direction to the upside. And then you have your Asian session consolidation like this. And then the market comes and consolidates and breaks to the downside like this and gives you a W formation. Now, a lot of people might enter this W formation thinking the market has to continue up because they're taking out liquidity. But that's not the issue. The thing is, the market has been going up for a couple of days, right? So if the market has been going up for a couple of days, we know that retail traders are buying this uptrend, right? Retail traders are buying this uptrend. So what do you think has to happen, right? The market has to reverse because people buying in here, their stop losses are going to be all the way in here, right? So there's a bunch of liquidity down here. It's a bunch of liquidity down here. Usually at support and resistance zones because a lot of people trade support and resistance, right? So knowing that when the market has been going up for a couple of days, 3 days or more, right? When you see something like this, you're not meant to take it back up because what the market makers are going to do is basically they're going to go up a little bit like this and then continue down and then go and hit all the liquid, take out all the liquidity that is located down here. So you have to know where you are in the market. You have to know when the trend is about to exhaust, when the trend is just starting, when the trend, because what usually happens is, let's say you've been going up for a couple of days. The best, absolutely best trade you can take is the market has been going up for a couple of days, right? And all of a sudden you have, let's say, a reversal here, an aggressive move down, like about 100 pips. Maybe from here to here is about 100 pips, right? So let's say this is 100 pips, right? 70 to 100 pips, right? And then the market pulls back and ends the day in consolidation. Now, the absolutely best and the safest trade you can take is this. After you see this reversal, it's called a safety trade, right? So because it's safe, because the market is just resuming, it's just starting a new trend, right? So the market has been trending to the upside, right? The market has been trending to the upside, and the market just reversed. Now we know that the market is going to start trending to the downside. So with this 100 pip move down, that's the sign of the reversal, this aggressive move down. What's going to happen if the very next day, the market gives you a stop hunt to the upside and gives you an M formation? This is your trade. This is your safety trade, right? Because you know that the direction of the market. You know that the market has been trending to the upside, and they have to go back down and take out the liquidity that is located down here, right? Because people have been buying. So you know that this move to the upside is a false move. They're going to take it down and take out all the liquidity down here. First of all, let's recap. The first rule you need to know is the Asian range has to be 25 to 50 pips in length, right? The second rule is you need to have aggressive movements outside of the box. And the third rule is you need to know where you are in the market. Is the trend just starting? Is the trend about to be over? All those things apply. If you add all those things together, it gives you a complete picture of the market and helps you predict the market with more clarity and with more accuracy. Well, if you found this video helpful, click the like button, subscribe to the channel, and also if you don't know what the Asian session liquidity is and you want to learn more about it, click the video on your screen. It'll teach you just that, and I'll see you on the next one. Peace.